This is the Commercial Real Estate Insights podcast. I'm Steve Hamoen, and it is 3:05 p.m. on Wednesday, March 26, 2025. Here's what we're covering today. First-time homebuyer affordability is collapsing in both the U.S. and Canada. Trump's new housing order may disrupt both ends of the residential and CRE spectrum, and what this affordability bottleneck means for multifamily, redevelopment, and retail opportunity zones. And in other news, Toronto's multifamily market stays resilient, despite deeper rate shocks and regulatory squeeze. First, let's talk about the elephant in the room. Home ownership is becoming an increasingly exclusive class, especially for first-time buyers. New affordability models released this morning show that even with a 10% down payment and assuming a 6.58% mortgage rate, first-time buyers in both Canada and the US are running dangerously close to the GDS and TDS thresholds of 39 and 44%, meaning more than one-third of their income goes to housing costs alone. We ran the numbers using the median U.S. home price of $398,400 and a median household income of $84,000 with a 10% down payment. Your monthly PITI clocks in at over $2,800. That pushes the GDS to over 40%, above the acceptable range for lenders. In short, the entry-level ownership class is locked out, and what that means for CRE is massive. So here's the insight. If ownership is no longer the primary path for shelter, CRE becomes the destination. Multifamily units, especially purpose-built rentals and fourplexes, are increasingly competing with ownership, not just supplementing it. That's a major psychological and capital shift. Next up, let's frame this within Trump's new emergency price relief order. Signed January 20th, the order directs federal agencies to reduce housing costs by eliminating regulatory drag, but as of today, no concrete steps have emerged. However, it's the mixed signals that have investors split. While the administration calls to cut red tape and unleash development on federal land, it also reinstated 25% tariffs on Canadian lumber and is tightening immigration, which could spike labor costs. The irony? While the memo aims to drop construction costs, the policy contradictions may actually boost CRE value by pushing more people into rental supply and tightening cap rates on stabilized multifamily. So what's the CRE opportunity? Let's zoom into Toronto, where a new report today shows 6,700 multifamily units transacted over the past 12 months, with a market sale price per unit of $360,800 and a cap rate holding steady at 4.1%. Despite higher borrowing costs and growing talk of rent control extensions, demand continues to outpace delivery. Inventory is tight, and even modestly improved units are leasing above historical norms. And there's more. Toronto is about to implement a major anti-rent eviction policy modeled after Hamilton's new bylaw. It will likely require permits for all tenant relocations plus coverage for temporary housing costs. This changes how investors underwrite older buildings. It adds risk, but opens the door for institutional buyers with longer timelines and value-add capital strategies. Meanwhile, in the U.S., we see similar dualities. New York, Miami, and Nashville all reported healthy rent growth in the 3 to 5% range as of February. Cap rates are firm. But more importantly, delivery has slowed, and that's the real pressure point. In San Antonio, net absorption is climbing while construction starts are dropping. This creates a supply-demand squeeze that will support investor margins for the next 12 to 18 months, especially in value-tier multifamily. Now let's flip this toward retail and redevelopment. If first-time homebuyers are increasingly renters, community and lifestyle assets like strip centers, suburban service retail, and mixed-use zones gain in value. Think about it. When people can't buy homes, they lean harder into local convenience, short-term leases, and walkable amenities. That's why certain strip retail centers, especially those near new multifamily construction, are becoming hidden gems for redevelopment. Here's a case to watch: Kitchener-Waterloo. With its strong tech base and rising immigrant population, the region is seeing a resurgence in multifamily demand, yet available rental units remain stubbornly low. Affordability constraints are driving high-income renters into mid-tier product, which creates upward pressure across asset classes. Expect to see adaptive reuse deals, where older offices or big box footprints convert into residential or hybrid assets. And let's not forget, institutional capital is hunting for scale. In 2024, over $2 billion in multifamily trades occurred in the Greater Toronto Area, despite increased rates. The average asset size, 68 units. That means the buyer pool is shifting toward mid-scale private equity, REITs, and family offices who can tolerate short-term cap compression for long-term NOI growth. So what's the takeaway? Affordability isn't just a problem for first-time buyers, it's the signal flare that a structural shift in the housing ecosystem is underway. Trump's housing order may be light on execution for now, but the market reaction is real, and CRE is absorbing that energy in rents, valuations, and capital flows. If you're a CRE investor, this is your moment to think bigger than buildings. Think systems, financing, supply chains, tenant mobility, and government friction. Where the public system fails, private capital will step in, and CRE will continue to be both shelter and strategy. That's all for now, but we'll be back tomorrow. Don't forget to hit follow or subscribe and leave a review to help others discover the show. I'm Steve Hamoen. Until next time.